Hello, and welcome to Talking Banks with Joe and Kevin. This is episode 9, and we're following up on our discussion last episode around private credit and the impact it's having on them and investors. But first,
Joseph Fenech and Kevin Swanson are employees of GenOpp Capital Management, an investment advisor that maintains exempt reporting status in the state of Indiana. This podcast represents the views, beliefs, and opinions of GenOpp members and does not assert to be complete. The information presented in this podcast is provided as of the dates indicated, and opinions presented may change. You should not rely on this podcast as a basis upon which to make an investment decision. This podcast is not intended to provide and should not be relied upon for tax, legal, accounting, or investment advice. GenOpp's clients or its members may hold or recommend to GenOpp's private fund clients the purchase or sale of securities of companies discussed.
Okay, so following up on our last episode, the topic again here is primarily private credit and what we're seeing in that market. That's clearly had spillover effects into the bank sector and bank stocks, and then more broadly, just how we're thinking about portfolio positioning. There's always a lot coming at investors, but it does feel like right now there's more than usual. So we'll try to frame how we're thinking about all of that. So just to quickly recap how we introduced this last time, the main point we made was that this is bigger than just exposure to software and AI disruption. That's part of it, for sure. But we think the concern runs deeper. It's really about the structure of private credit and private equity market, the underwriting, the pace of growth over the last decade, much of it in a very low rate environment, the marking of these assets or lack thereof, and then the illiquid and opaque nature of it all. And you've seen those concerns show up in the stocks, first in the pure private credit and private equity names, and then more broadly across banks, life insurance, capital markets, really anything with exposure to that ecosystem. So that's where we left it. The question is now, what happens next?
Yeah, I think that's exactly right, Kevin. Before we get to that question, I just wanted to spend a minute going a level deeper on how this system actually works, because I think that's really the key to understanding what's going on. If you take a step back, a lot of what we now call private credit used to sit on bank balance sheets. After the financial crisis in '08 and Dodd-Frank in 2010, a lot of that lending got pushed out of the regulated banking system. And then if you fast forward to around 2020, you started to see the banks creeping back into the system, but not in the same way, in more of a backdoor sort of way. They're lending the private credit firms, they're partnering with them in some cases. They are directly lending to the companies in some instances, but overall, they're participating more indirectly. Then you've got the investment banking firms that are sort of a middleman. Structuring deals, they're setting up SPVs, special purpose vehicles, helps to minimize the capital charges for the banks if they're in these vehicles. They're helping them move risk around, and in some cases, they're putting their own capital to work. And then you've got the life insurance companies, which are some of the biggest buyers of this product. And that part's really important. There are a couple reasons why they like it, the life insurance companies, that is. First is the yield, especially in a low rate environment like we were in for so long. This was a way to pick up incremental return, but more importantly, it fits their business model and their balance sheet. They have long dated liabilities, policies that may not pay out for years or decades, so they like the long dated assets that private credit offers to match that. And because of that, at least in theory, they don't need the liquidity immediately. They can ride through the volatility and hold these assets over time. Now, that works as long as the underlying credit holds up and you don't get into a situation where liquidity suddenly matters. So that's basically the flywheel in the system that we're dealing with today.
And we've been seeing weakness in the pure private credit and private equity stocks for a while now. A lot of insiders sold last year, and then the market was beginning to anticipate issues before obvious cracks started to appear. And then where brands and Tricolor went down last fall, you saw it start to spill over as life insurance stocks reacted and bank stocks had some very rough sessions. And we also had liquidity pressures at the time as QT was winding down. We discussed that at length last fall. That has since improved. The life insurance and bank sector stocks largely recovered a lot of the lost ground in the fall of 25 by year end.
Right, but this year it's been a different story. The life insurance stocks, the big banks, the capital markets firms, more recently the regional banks, and of course the private equity and private credit stocks have been pounded pretty relentlessly. And what's notable is this. The companies with the most exposure to private credit have clearly underperformed. And across those sectors, those names are actually more correlated with each other than with their own peer groups.
So that leads to some key questions. Could this be systemic? And is this really a credit problem, or is this more about structure of the system and liquidity?
Well, first as a sidebar, got a bone to pick with the Wall Street Journal. They've again made a few attempts here in the last week to try to paint the banks as being at the center of the problem. I don't know what's going on at the Journal. It has to be something, but the Journal has had it out for the banks in my mind for a while now. I think back to when New York Community Bank looked like it was going down in early 2024. And the Journal had run a story not too long before that in describing some of the issues in commercial real estate. And the headline, and I'm paraphrasing here, was that there was $3 trillion of this type of problematic commercial real estate exposure on bank balance sheets across the country. And we remember thinking to ourselves, really? There's really $3 trillion of office type real estate in major metro markets. And then more specifically to the New York Community Bank situation, there's this level of exposure to rent regulated multifamily exposure in New York City, where laws were passed 5 years earlier, severely curtailing the ability to raise rents right before costs started going up, right, with inflation and everything else. So the implication in that article was that, banks in like Wisconsin with commercial real estate exposure in office buildings that are 2 stories high, with like a dentist's office on the first floor and an attorney working upstairs, that bank has problematic office real estate exposure akin to what New York Community Bank is facing in New York City. Because that's what the Journal headline implied. And that led to a sell-off in all banks that were perceived as overexposed to commercial real estate more broadly. And it really turned out to be a blessing for us, because the first thing we did was we went out and bought all those supposedly overexposed commercial real estate heavy banks. And ultimately, it was a nice driver of fund performance for us that year. But it was harmful to the extent that we had to spend the next 6 months explaining to generalist investors that had been interested in investing in the bank sector why those fears were overblown. And so we're seeing the same type of headlines now out of the Journal, somehow attempting to subtly shift the blame from the private equity firms, the private credit firms, where the vast majority of this stuff originated, onto the banks. So on Friday, March 13th, there was an article with the headline, "Why Bank Stocks Are Getting Beaten Up Over Private Credit." And then on Monday, March 16th, earlier this week, another headline article entitled, "The Blow-Up That Exposed How America's Banks Are Entangled in Private Credit." And look, the goal here is not to absolve the banks by any means. I don't like how the banks have sort of backdoored their way back into this business quietly over the last several years. I think what happened is in the 10 years after the GFC, loan growth was very weak. We had a weak recovery coming out of the GFC. It's still, loan growth is still weak today, but it's now improving for the banks. And this area was where the growth was. And the banks couldn't participate directly, so they did it indirectly through these partnerships and intermediaries. And then in the last few years, really accelerated the push into this business. And now they have this exposure that I feel like they don't really understand, because in most cases, they didn't originate the credit. But that's a key distinction. And I think that's really the most important point here. In 2008, banks are at the center of the flywheel. They were the originator of the credit. They did the underwriting. They had the bulk of the exposure. And the other financial subsectors were sort of tangential to that through their tentacles into the banking system. Now it's really the other way around. The banks are the ones that are more indirectly exposed, despite the best efforts of the Journal to paint a different picture and shift the narrative here. And I think for this issue to be systemic, or even for it to become orders of magnitude worse from here, I think the banks need to have been more central to this process and have more significant direct exposure to the core problem than they do. But having said that, the banks still have a few problems here. First, my fear is that a lot of these bank management teams, as I said earlier, don't know what they're exposed to. And I don't like the lack of control they seem to have over the process as these credits go bad. It reminds me of the of the issue we used to see during corporate credit cycles with shared national credits, where the smaller banks would participate in these larger national deals where they weren't the lead bank, and the credit would go south, and the smaller bank's fortunes on that credit were tied to the whims of how the lead bank treated that credit. And so they were sort of powerless in the process. It seems to us that these one-off fraud situations that we've seen over the last several months have in some cases caught the bank management teams completely by surprise, even at large regional banks, as though they didn't even know they had the exposure they did to the credit. And in some cases, these are big exposures we're talking about. And unlike in non-regulated sectors where there's an ability to kick the can and not mark your book, you don't have as much leeway to do this in banking. So you see these situations develop, and immediately the banks are writing these things down and taking losses. And that generates headlines, obviously. And then the industry collectively I think in talking about NDFI exposure to non-depository financial institutions, which is how this stuff is bucketed, in talking about that and attempting to explain it away, the industry has sort of leaned into this mantra of, well, the stuff we do, the categories we're in, have never had a loss, really, so we're fine, despite this stuff being sort of a black box. And so what I would advise as a bank investor to bank management teams is two things. First, take this scare as an opportunity to reduce exposure to private credit, or just more broadly, credit that isn't underwritten by you and goes through your loan committee in your underwriting process. It's not relationship business. You're not going to get credit from investors for the additional loan growth because it's going to get outweighed by the opaqueness that Kevin talked about earlier and the credit risk. And second, improve the disclosure. I want to hear that the credit exposure you have has been underwritten with the same level of care as your directly originated portfolio. I don't think it's going to be sufficient to say, well, the vast majority of our NDFI exposure is to capital call lines and mortgage warehousing, so we're fine. And I don't think it matters if the exposure is in an SPV structure or some fund and the disclosures aren't adequate and you lean on that. If that's the case, then why are you in that? And if you are and you can't tell us what that is, then conservatively as an investor, I need to discount that when I'm considering your overall credit risk. So you have tentacles here as a bank into something that we think is going to drive the next credit cycle. I don't know when that's going to be. And if we're right about that, we care a lot more about that risk, that downside risk, than we do about the benefit you'll potentially see from a few extra points on loan growth over the next few years. And so again, these problems on the whole don't need to be all that significant for them to present major issues for the stocks. I think every time you get one of these situations like MFS in London or First Brands or Tricolor last year, you have the potential for the banking index to take a good sized hit. We've seen multiple 4, 5, 6% down days for the entire banking index because of these one-off situations over the past 6 months. And I think, unfortunately, that's going to continue to be the case, which on the one hand presents opportunity because, again, the level of overall exposure for the industry doesn't warrant that type of reaction. But it's also going to lead to investors avoiding banks that have exposure and disclosures that don't allow people to get their arms fully around the problem. So it's both a risk and an opportunity as I see it.
And I would just further emphasize that despite the volatility that this has introduced, we really do see it as an opportunity as well. Because just like with the commercial real estate issue from a few years ago that Joe mentioned earlier, the majority of banks don't have any exposure to these assets. Within the group of public banks that we look at, this is an issue for the too big to fail banks and the larger regionals. There are just a handful of banks under 50 billion in assets that would have any exposure whatsoever to these areas you're seeing in the headlines. So when the index sells off 4% a day because a few large regional banks have exposure to First Brands, for instance, that sell-off takes the smaller banks with no exposure down with it. And so that's the opportunity. You just need to be able to stomach the volatility.
Yeah, 100%. And so that brings us back to the question of how serious are these problems for the financial system overall? And is there another leg down from here for the pure play companies in private credit and private equity, and by extension, the banks and these other impacted sectors? And what I would say to that, look, it's not impossible. There's always potentially another shoe that can drop. And certainly things could still develop with the war and the implications from that for credit and the economy. But based on where we sit today, we think it's probably unlikely that we see this explode right now into a major credit problem for the economy. So not quite as negative as we were on pure private credit, pure private equity, as we were before this stuff was better reflected in the stocks. So I think to this point, the problems that we've seen speak to a somewhat flawed underwriting structure and idiosyncratic credit issues. So for instance, Tricolor was a subprime auto lender that catered to immigrants and people with very limited credit history. And so you could point directly to a reason why this company ran into trouble. Obviously the change in immigration policy and the overall struggles in subprime auto more generally in a higher rate environment, has led to a problem in that business. Now, what that exposed, per news reports, and we don't have all the info yet, was seemingly an underwriting structure that raised some eyebrows. And with allegations of double pledging of assets in the situation with First Brands, for example, and then more recently with MFS, with speculation about potential collateral shortfalls. And it provoked this thought that if that was the common denominator in terms of underwriting and structure, was this practice more widespread across the private equity and private credit ecosystem.
But in our conversations with the banks, they aren't seeing any issues in their originated portfolios. So they have exposure to first brands, for instance, and in some cases they lent directly to the company, and in other cases they have exposure through these SPV structures set up by the investment banks, but they aren't seeing any issues in what we'll term as their core underwritten portfolios. And that's across the board on the consumer and the commercial side, from best we can tell.
Right. And so that's what leads us to think that as of now, this is a problem in private credit and private equity that relates to underwriting philosophy that gets exposed when you have these one-off credit blips. And so make no mistake, when we see a credit-led downturn, we think this stuff is going to be a major problem, like a major problem. But what you need, I think, right now for this to be a major problem for the entire ecosystem of private equity, private credit, banks, life insurance, and capital markets, I think you need a downdraft in the overall credit environment and the broader economy, and we just aren't seeing that. We talk to banks literally every day, at minimum 5 a week. I just met with 6 of them in person on one day on Tuesday earlier this week. And the credit issues just aren't there. They aren't seeing them. And to the smaller banks, this private credit stuff is close to being a foreign language. They're not involved in it at all.
Yeah, so in effect, what you're saying is at this point, the issues that we're seeing playing out in the market primarily relate to, first, questions around loose underwriting and structure around these select one-off credits that seem to have idiosyncratic stories to each of them that aren't really related to each other, aside from the concerning similarity in how they were structured. And second, the issues around redemption requests at these funds, questions around whether the portfolios are marked appropriately, and then liquidity. Is that a fair way to summarize the concern?
I think so. And I don't want to minimize how serious of a concern those things are. In some respects, they can lead to new and more serious issues, so it becomes potentially a negative feedback loop. But I think if the challenge remains restricted to fund gating and redemptions and illiquidity, which, by the way, are all perfectly acceptable responses that are built into these private credit funds and the agreements when these funds were set up. So whether people read the fine print or not is another issue. But this so far is not a disorderly situation where the funds or the companies are sort of acting in a way that's sort of contrary to investor interest, right? It's like this is how these things were set up. So if that is the issue and the marks are just too aggressive in some cases or in a lot of cases, but the underlying credit quality for the most part holds up, if that's what the issue is, I think the damage to date in these stocks, give or take, probably adequately reflects those challenges. I think to see another major leg down and significant spillover to banking and life insurance, I think you need to see credit deteriorate more broadly. And what happens at that point is the rating agencies, and let's be honest, there have been questions around how these credits are rated, but if you start to see credit downgrades, that disturbs the ecosystem in a more meaningful way, in the sense that with life insurance, for example, there is more punitive capital treatment of these assets if they're no longer investment grade. They're obviously illiquid. The match funding becomes an issue. And then for the banks, they're recognizing these issues as they happen. So downgrades of the credit by the rating agencies is when you would just see a tsunami of issues, right, for everybody. And everyone gets hung up on the definition of systemic, but something doesn't have to be systemic to be potentially really, really bad, right? I mean, remember back to 2023 when you had the liquidity panic, the too big to fail banks were never perceived to be on dangerous ground. They were actually net beneficiaries of the problems we saw in the failed banks. Remember, people were moving their money before First Republic failed from First Republic to like JP Morgan. So it was never systemic, but 3 large regional banks still failed, and there were concerns about a potential deposit run on the regionals. So not technically systemic, but at that point, who cares? It was still really, really bad. So unfortunately, I think this is a question of if, not when, in terms of this being the next big trouble spot for credit and the economy. We just don't think that time is now. But it's like, there's sort of a big piano suspended by a wire hanging over the heads of the system and the individual companies in it. And the wire holding it all up is still strong enough where the piano just sort of hangs there. It doesn't fall on you, but you got to kind of keep your eye on it. So if you subscribe to the notion of if, not when, then I think if we're right that the system gets a temporary reprieve here, we think it would behoove banks not to say, okay, see, everyone overreacted, there's no problem here. Instead, take advantage of the reprieve and the scare to say, you know what? We're going to meaningfully improve our disclosure and our own internal understanding of what we're exposed to here. We're going to re-underwrite this exposure as we would our own, and we're also going to move to reduce exposure to this asset class overall. And if not, I don't think at GenOpp, we're going to be alone among investors in the space and saying, you know what, I need to move to banks that just don't have this piano over their head at all. I don't care how strong the rope is holding it up. If you can't help me understand the risk and you still think this is a good sandbox to play in, you're going to have an overhang over your stock, I think. And investors like us are just going to stay away. And in the banking sector, the good news is we have plenty of optionality to do just that.
And we've talked about this before. We have a proprietary scoring system that scores each bank we evaluate on a range of quantitative and qualitative metrics. So it's not that it's absolute that we wouldn't touch a bank with this type of exposure, but the hurdle that stock would have to overcome to garner a score that would lead us to consider it for a spot in the portfolio, this issue alone would probably make it prohibitive. Joe, any other points you want to make on the tactical positioning here from an investment standpoint?
Yeah, I think you hit on an important point there, because the discussion to this point might seem overly theoretical and that we're splitting hairs on these points about how this private credit situation turns out. But that's where the distinction really matters. If you think, as some of the commentary and analysis I've seen would suggest, that this is a huge overreaction on private credit and private equity, you might be inclined on the bank side of things to buy the stocks most impacted by the overreaction, like we did during the commercial real estate scare a few years ago. But that was a fundamental misunderstanding of the exposure around commercial real estate and the narrative around it. In that case, the risk was clearly overstated. Here, we think the structure itself is actually more problematic, even if it's not showing up in the same way yet. So while this might not be the quote-unquote big one from a credit perspective, for the economy as a whole, we think it will come at some point. We just don't know if it's a year, 2 years, or 10 years. So then, if you weren't already worried about this exposure, this scare, we think, should be sufficient to say, you know what, that group of banks no longer intrigues me. And you can do that because, like I said earlier, the entire group has been hit here, including banks that literally have no exposure whatsoever to this issue. They might not be as down as much as the ones with more direct exposure, but the risk-reward dynamic from this point is still much more favorable to just avoid that group entirely. Look, having done this for a long time, there are three things that can sink you in banking, right? Credit, capital, and liquidity. And when one of those issues is present, or you can see it on the medium term or even longer term horizon, the upside reward in the interim is never, in my experience, enough to offset the potential downside risk down the road. And not to sound like a broken record here, but just, we're also going to continue to hammer on this question of activism in banking because we keep getting questions about it. But we think, the events of the past few weeks really drive home the point that we've been making for a while now on activism in the bank space. Events can come out of the blue at any time. And never has this been more true than in the past 6 weeks. Very few people, including us at the start of this year, had war in Iran and $100 oil on their docket of things they were expecting in 2026. Very few people had this AI/software concern and the tie-in to private credit and private equity that really sparked this whole recent panic around it. And the reason is because it's really, really hard to predict these sorts of things. And when these things happen, it can't help but put a chill, at least temporarily, on the M&A environment. And not surprisingly, some of the regional banks that were widely perceived to be potential M&A targets, these are banks that also screen poorly on some of the problematic exposures on the credit side that we've been talking about with private credit. And again, these companies just generally tend to be subpar performers, which is why they're M&A targets in the first place. So if something happens that you don't expect that derails the M&A thesis, and when you're talking about activism, you're concentrated in names that probably will underperform the broader universe of bank stocks in a downturn scenario. And again, the derailment of the regional bank M&A thesis is still not our base case scenario. The M&A angle is still a meaningful component in our view of an overall bullish bank sector thesis. But if you have a bear case and a base case and you weight them, the base case after the events of the past few weeks, the weighting of that is probably a little lower in terms of the probability of it occurring, particularly around M&A, and the bear case odds are probably a little higher following the events of the last few weeks, even as the overall bullish thesis remains intact. Our base case scenario is still the more positive bullish take. So our take has been and remains that you can play these themes, and we are playing them. As we said earlier, We were in Comerica, we were in Webster when those banks were taken out, but you also want to maintain strategic flexibility in how you manage the portfolio as things evolve. So with that, Kevin, any closing thoughts as we wrap up here?
Yeah, I think you said it well. Macro risks have clearly gone up over the last several weeks, and then you have a broader financial sector credit risk that has increased as well. I think the geopolitical risk in isolation we'd be seen as an opportunity to get much more aggressive in our positioning, but the credit risk aspect of it layered on top of the macro has given us a little bit more pause. But overall, still a very manageable situation. And again, we continue to see opportunities as stocks have corrected. And overall, the thesis that we've articulated for a while now, we think remains intact.